All right, so I wanted to go over the Lemonade earnings. I have been meaning to do this for a long time, so I'm just going to go through it right now, real quick with you guys. Going to be a short video. Not planning on doing anything ridiculously long, and gonna kind of go over here exactly what happened with Lemonade earnings, because I know a lot of people were wondering, hey, their earnings are really good. They increased top line, bottom line, profitability expansion, and everything, or at least closer to profitability expansion. But the stock is down like 26% from its earnings print high, right? So I think we're going to go over a little bit of that today. It might not be the answer that you're looking for, but it is certainly going to provide some clarity as far as the bull case for Lemonade. Now, to preface and disclosure, this is not financial advice. This is just purely for entertainment purposes, whatever. But I do not own Lemonade anymore. I've already said it many times. I sold it around $75. Don't plan to add it back anymore. Already got like a 3-bagger from that one. So we'll see where it comes. And maybe it comes back to certain levels. I might be interested, but I don't think this is particularly the market that's going to be that's going to be appreciative of not pre-revenue, but pre-profitability or very close to profitability companies. Especially in the software sector, and Lemonade is a software company, so we need to remember that. All right, so let's go to the Fiscal AI. Actually, let's go to the slide real quick. Take a look at what they posted on their earnings here. All right, so over here, we have the slide deck. Actually, no, this one. Over here, we have the slide deck as far as how they did in their earnings. We have in-force premium, which is probably the best metric. Probably the best metric to have as far as measuring how good, or the forward guidance as far as how good a company is going to be doing in terms of their insurance premium they're going to be collecting from a lot of their clients. They grew that at 31% year over year, which is really good, because if you look at this chart over here, you can see that the in-force premium is just growing, right? So it's obviously not growing due to the law of large numbers, but it is still growing nevertheless. Now, if you look at the adjusted EBITDA, they are inflecting right on profitability on an adjusted basis. But more importantly, the net loss, which is not adjusted, they're getting closer to profitability. The GEP that they have over here is still growing in millions. That's basically their premiums that they do collect, $290 million for this quarter. And the gross profit margins is pretty decent. It is expanding. So that's good news to see. You know, I think what the way the market is looking at it is that they're tying this in the software bucket. But even for a quote unquote software company that is also in insurance, 48% gross margin is actually really good, considering the scalability that they have for their platform by utilizing AI. So they can increase the amount of clients that they have exponentially while reducing overhead costs, or at least not dramatically increasing the overhead costs due to the use of software and AI, right? So that's the whole moat with this company, is that they're able to use AI to figure out the algorithms that they need to put in to project basically how much to charge in premium for someone's estimate versus whatever the market's offering and their risk and so on. Adjusted free cash flow is actually doing pretty good this quarter. They came in at $37 million. 2 years ago, they were negative adjusted free cash flow, and cash flow from operating activities, which is probably the more important metric when you take out the investing cash flow as well as the keep reading the last one. But when you're just looking at the cash that's from the operations itself, they're at positive territory at $21 million. So exclude the adjusted number, because obviously they do have these other activities they're doing on their cash statement. But if you look in their operating statement, their operating cash flow or cash from operations, that's at $21 million, which is still good considerably. Last year they're at 14, and 2 years ago they were at negative 16. All right, so the top line growth in force premium already went over. Revenue grew at 53% to 228 million. But when you're thinking about insurance companies, you're not necessarily taking the total amount of revenue. You're taking more of the net revenue that they get after they pay off all of the claims that they're doing. Gross profit, I already went over, that grew by 73% year over year. Adjusted EBITDA, already discussed. Cash flow, already discussed. So in-force premium growth. What is in-force premium? If you take the existing premium that they're getting, basically how much people are paying to insure with Lemonade, and then you multiply that by 12 or annualize that based upon how often they're going to be paying, whether it's 6-month premium windows or 12-month, that is has been accelerating, which is really good to see, because when you have this reacceleration of IFP or in-force premium, this is showing that the company is gaining more business in the market, right? They're growing market share. Now, if it still grew at 30%, then maybe you could think about inflation, how rates get higher and so on. But the fact that it reaccelerated to 31% just shows that they have great pricing power, and the fact that they're able to acquire more clients. Like, they're already expanding their auto segment. They also have a pet segment as well. They're going to be going into home insurance segment, at least in large states like California, New York. They're expanding their business. Trailing 12 months, which is your TTM, gross loss ratio, you want to see this number go down. So they collect a lot of premium, or they collect whatever premium from each client that they get to insure them. And they're also have basically an average payout over the entire base for how much they're paying out in terms of claims, right? So if someone gets into a car accident, depending on the severity of the car accident, you have your deductible and all this stuff. You deduct that from the amount of premiums that they get, and their total gross loss ratio in the trailing 12 months is about 64%. And you want to see this number go lower, and they are executing good, because this number is going lower. They started 2 years ago, they were at 88%. Now they're at 64%. So they are becoming a much more profitable company, charging the right amount of premium, alleviating to the right amount of risk that they're taking on by signing on this client. In-force premium versus OpEx excluding growth spend. All right, so this is important too, because this is showing you that they're able to keep their growth under control, right? So they are growing their OpEx, basically their operating expenses, their overhead. They are growing it, but it is staying consistent and tame and under control, while the in-force premium at the end of the period is growing much more dramatically. That means they're able to expand on their market and how much you're collecting in premiums, basically what they need to actually get revenue. And they're able to keep their costs under control. So when you have the amount of money you take in increasing and the cost staying here, that means that the company is profiting more to the bottom line. Key growth drivers. They discuss things that I just mentioned, except they go into a little bit of detail in the segments over here. Pet is increasing. It increased by gross loss ratio, but arguably this is still a decent size sector in them, but it's not going to be as important as the auto segment. So if I scroll down here to car or the auto, this is the one that decreased by 23 basis points. This is going to be the important one that you need to look at, because this is going to be one of its fastest growing segments once they reaccelerate that across the entire US. And this, of course, is the TAM expansion, because we already have that they partnered with Tesla in order to offer reduced or 50% discount when you use FSD, using their insurance policy and so on. It's definitely going to be very beneficial for them in the car in the long run. They do have the pet insurance, which obviously brings in a lot of revenue, but I would argue that this is not going to be the massive growth driver that you're going to be seeing across the entire segment. It's going to be the auto. All right, so let's go down here to they discuss the investor day, and then we get the guidance for Q1 2026. They come in here saying the in-force premium for next quarter is going to be growing still at $1.3 billion, and then $1.6 billion. Gross earned premium is going to be increasing as well. Revenue is going to be increasing, and adjusted EBITDA loss is still going to be at a loss for the entire year. And they are keeping stock-based compensation under control, because that's just showing over here that their weighted average common shares is increasing only by 1 million versus basically out of control, which is what you see with a lot of software companies. KPIs here that they are measuring on a non-GAAP basis. You really went over most of this stuff. They increased customer count by 23%, and premium per customer is increasing as well. Let's take a look over here on the fiscal AI. Yeah, I already went over that part. Let's take a look over here at some of the metrics over a period of time on fiscal AI. And we have, where was it? In-force premium, which it did show on the chart. So I'm going to overlay that with the change percentage. And if I displace that on a quarterly basis, you're going to see here that the in-force premium is going in the right direction here. And it's also accelerating like they had shown in the previous chart that they showed on their slide. They didn't have back here, but what company was not doing well during 2022. So they did need a little bit of time to reaccelerate. And if I do overlay the stock price over here, you can see that the stock price does track pretty closely to how well they're doing in terms of the in-force premium acceleration. You saw this big hike in the stock price over here because their in-force premium went from 26.9% to 29.2%, and then now it's 31%. But the thing is that I guess I'll get a little bit into the reason why it sold off, because I think it's a bit more to do with this company than pretty much micro specific. And I wanted to touch on that one. But looking at the stock price, obviously the business is doing well in terms of the in-force premium, and it's expanding pretty well. Every single time you see these big jumps in in-force premium, that's when you see the stock price jump as well. Same thing over here, 26.9 to 29%, and that's why this one's jumping. And you saw continued profitability expansion over here, which brought the price to about $100 a share. And clearly that's not where it's trading today. Is that Fiscal AI the best stock research platform which you can get a 2-week free trial on, no credit card required, using the link in the description? Yes, it is. It is. And I will probably, you know what? This guy, Aria, is probably has brought a lot of business to Fiscal AI because he used it in a lot of his videos. Shout out to Aria, and also shout out to 3 Plate Nate. But I've been using this platform for a while. I'm going to throw the link in the description just for all you guys out there, in case guys and gals out there, just in case you want to check out the platform yourself. But I use this for everything. It's a very useful application. I'll put the code and the link for a 2-week free trial, no credit card required, risk-free rate. Right. All right. So, anyways, I don't want this to be like an advertising segment, but I guess I might as well just share some of the tools that I use. So another metric that we have over here is the gross loss ratio, which I showed you before. And you can see the gross loss ratio is coming down over time. They did report this quarter, but then we reported this quarter, the price started to go up because they basically forecasted the gross loss ratio was going to come down dramatically, which it did, in fact. And you could see here it's at 52% for the quarter. Again, I'm going to go over this fall off here at the reason why it dropped. All right. So let's go down here to, actually, no, I want to go to the chart now. We already went over the fundamentals. We went over the earnings. Now we're going to go over the chart over here to kind of go over what happened here. All right. So I'm going to basically walk you through when the earnings released to where it pretty much ended up today. I'm going to go over some technicals, and then I'm going to kind of go over a little bit of macro. Why ultimately I think the company dropped 26% after earnings, right? So we had the earnings print, and let me actually take this one out. We had the earnings print in the morning, and the stock jumped. Everyone was happy, right? The stock closed here the day before. It's right here, closed right here. And it was up as much as like 17%. I remember when I woke up this morning, I was like, wow, that's amazing. Stock is up 17%. I didn't think it was going to hold, though. And the reason why I didn't think it was going to hold is because you saw this many times in many other companies. You saw with AppLovin, where AppLovin was up a lot after earnings. Actually, no, technically AppLovin went down after earnings. You saw with Reddit. Reddit was up a lot after earnings, got sold off. You saw Rubrik had the pre-release in the earnings. It went up, and then it got sold off. Amazon, of course, the big dog in the room, had really good earnings. It got sold off. Like, hey, these companies are getting sold off after they report good earnings. Why? I'll get a little bit into that in a second. But then after that, as soon as the market opened, it basically sold off. Like, this is a 15-minute chart. In 45 minutes or an hour, it literally gave up all of its earnings gains plus more. And then the days continued. We got into today, and it was down another 7% today. All right. Here's the laydown. This is not a favorable environment to be buying and chasing growth stocks. And the reason why I say this, and a lot of you guys don't really want to hear this, all right, because I got a big company reporting on Tuesday called Zeta, which is a decent size of my portfolio. And I'm super confident the numbers are going to be good. I just don't know how the market's going to react, because in this environment, growth stocks, no matter how profitable they are, no matter how much inflection they are getting their profitability, are getting sold, even off good numbers. And I thought, okay, maybe this has to do with valuation, But then Reddit got sold off after the earnings, and it was actually a pretty good valuation. AppLovin got sold off at the earnings pretty dramatically. And arguably, from a historical basis, it's trading at a really pretty good valuation from a historical basis. I mean, Adobe had good earnings too, and they got sold off, and they're even already at an attractive valuation. I stopped myself in that position, and a few people here probably already know about that one. We saw many of these great companies get sold off, even though they were considered pretty cheap compared to historical valuation. Even Amazon, it's cheaper than where it was after the earnings, after the print, and even cheaper because it went down. So what's happening here? All right. The market is not favoring tech right now, and this might not last forever. It might last for 2 years, another year, it might last for another week. Who knows? The thing is that in this current environment, the market is not favoring tech stocks, and specifically anything that has to do with software, anything that has to do with software. So you had a lot of software companies report great numbers. You get one headline, CrowdStrike gets smacked across the face because the Anthropic code security is a new product that's released to basically scan your code before it's released. What does that have to do with cybersecurity? The market doesn't care. It's going to sell it off. I'm not saying to not buy anything. I'm just saying that this is probably more of the reason why the market is getting sold off, or they're selling off companies that are good in earnings. Arguably, though, Lemonade is not a profitable company, so it's not going to be as sympathetic for a company like that, especially because it's not profitable. Now, pre-revenue companies got it even worse when it comes to their earnings as well. What are they going to report? They have no revenue. The market doesn't care anymore. 5 months ago, different story. We'll give it its premium. Lemonade was at $100 a few weeks ago. Now it is basically down almost 47% at $57, right? Not forgiving. Are we going to sit over here and think we can forecast the bottom as soon as it happens and go heavy with calls? Probably not the best idea to do. So that is my thesis on the reason why Lemonade went down after the earnings. Now let's just take a look at some quick technical analysis here in the daily chart. Let's take a look at the moving averages. So Lemonade closed today at the 100-day moving average. Again, it wasn't too long ago when it was trading here around $100. Now it's here basically cut in half. If you're going to get a bounce, it'll probably be here. Find some support here because you can see here that it tested the 100-day moving average and then it bounced, but then it proceeded to go down. And this happened after the earnings when it got sold off, right? So how do I feel about this? Well, I mean, it found a lot of support on the 50-day and the 20-day moving average for a while. And then it just broke trend line over here and it just sliced through everything, right? This is a growth stock, a high beta growth stock. You can expect these type of things to happen. It's never going to be strawberries, cakes, and rainbows all the time. You're going to go through volatility, right? I mean, if you bought Lemonade all the way down here, like you're probably not going to care too much if you're invested for the very long term in something like this. But over here, if you're looking to add into the company, this might not be the best. It might be a decent idea to maybe throw a little bit of tranche at it if you are investing for the long term. For me personally, I'm not going to buy it, so you don't have to either. And I'm not even telling you to buy it because, of course, this is not financial advice. But technical wise, this does seem like a decent point to buy. However, we can open on Monday and this thing can open lower. So you got to keep that in mind. And I don't think you can really buy right now. Maybe you have like an hour to buy it after hours if you feel like it. But I would not buy this thing. I would wait for things to stabilize. I mean, I was buying Lemonade down here, over here as well. Like, so like things were kind of stable over here. This is just like a super parabolic chart, which you can go up and down in 5, 10, 20% directions without any reason why, right? So you obviously had good earnings and it sold off. Like why? Like why didn't that sell off before the earnings or after the earnings? Like, no, it was just a liquidity grab. That's what it seemed like. Hedge fund managers or fund managers or large desks traded this thing all the way up pre-market, and then they sold everyone the bag as soon as the market opened. Right. So they were able to sell into liquidity versus buy into low liquidity after hours. All right. So, I mean, we look at some other companies, ASTS, this thing was like $120. Now it's down here at $80. Rocket Lab, this thing was $100. Now it's all the way down here. Right. Like these are not good signals to continue writing calls to the upside. This is a very risky environment. So I would just spread a little bit of caution there if you are into that game. But if not, hope this video did provide you some clarity in terms of the earnings and why it might have fallen. And be sure to check out the link below for the Fiscal AI 2 weeks free in case you're interested. All right. Thank you very much, guys.